All right, welcome to our lecture. And I'm Deborah Toohey here with you. We'll give everyone just a few minutes in case we have anyone here, but I will be recording this for you guys and posting that recording probably by later today or in the morning. It takes a while for the recording to process and be available. So let's give everyone just a few moments. right, let's get started. And again, I will be recording this in case anyone else shows up or wants to hear it later. But welcome to our lecture today. And what I want to go over is some of the information that is covered in Module 3. We discuss in Module 3 the topics that are discussed in Chapter 4 in Principles of Managerial Finance. So this week we focus a lot on cash flows. And as you'll notice, I'm going to have a lot of information for you on cash flows today. There are cash budgets, there are the statement of cash flows, which is one of the 3 primary financial statements of the firm. And so we're going to learn the importance of cash flows to the firm. Very important as the financial manager, probably your most important part of your job. And so we're going to spend some time on that, making sure that we know how to effectively manage and understand our cash flows, predict them, and prepare for them. And a lot of people are going to be depending on you to be that person. I've been that person, and I end up being that person a lot, that makes sure that there's enough cash flows. And maybe you can even picture, if you want to take it down to the level of your own personal lives, right? Isn't there always that person that's really good at anticipating what expenses are coming due, even on a personal level, right? You know you have a certain big payment coming due, let's say the property taxes or some repairs, and that person that has put aside the money so that it times nicely with when the money is due. And that really helps because otherwise you're going to have to go to alternative methods of financing, even in your personal lives, right? You're going to have to go to a credit card or go to the bank or just avoid doing whatever it is that you had to do. So on the firm level, it's just as important, if not more important, as the success of the firm depends on your ability to manage those inflows and outflows of cash. And that is the main topic for this week. Tying it back to last week, we discussed some ratios being some good predictors of the firm's health, liquidity, and profitability. And when it comes to looking at cash flows, we're going to see that our financial statements are really concerned more with profits and growth and size of the firm. Very, very important, of course. And we're going to be preparing them in accordance with generally accepted accounting principles and practices, which means that some items on there do not really belong when we're trying to predict cash flows. And that's really the main key takeaway from being here today, or for even doing your reading, is to know the reason we have to do this is because our financial statements are not useful for this. You would think if you looked at them, we're making a profit, everything's great, you would think that you could use those. The problem is that when we do things according to the GAAP, we are making various entries based on aligning the occurrence of items and expense with when the income is aligned with it, a obligation at the time that it is due, not even if it is paid late or early. We take things like a major piece of equipment. We know that we paid, let's say, $50,000 for a piece of equipment, and we know that it's going to be useful to us for 5 years. Well, we are not going to subtract $50,000 off our income statement for something that we know we've got 5 years to make some good money using that machine. But what's the problem? The problem is that we did put out that $50,000 on day one, and our financial statements don't show that. So that plus some other reasons are the examples of why our financial statements will not be the way that we can predict our cash flows. In other words, what we're going to be doing is converting back to the cash basis of accounting. It's kind of the simplest way to put it. When we predict our cash flows, we are going to go back to what we didn't realize before we took accounting, but just making entries as the money moves. The statement of cash flows is broken down into three major sections. I have a video on it and some slides too. But it's broken down into three sections: operating activities, investment activities, and financing activities. And we'll need to show the items grouped into each of those three categories. Just so you know, and it's just a rule of thumb, it's not any particular guarantee, but most of your activities of the firm are going to belong in operating activities, just by definition of what belongs in operating activities, the day-to-day activities of the firm, those inflows and outflows. In the investing activities, there might be changes in your equity investments in firms. There may not be this quarter, there might not be at all, but that is the section investment activities. In financing, if we have any activity on notes payable, it would go here. Activities on long-term debts, changes in equity, and also if we paid a dividend. So again, these activities may come into play every quarter, every month, maybe just once a year. Another term that comes up with the statement of cash flows and cash budgets is free cash flow. And free cash flow has a formula that is very good to know. It's free cash flow is equal to OCF minus NFAI minus NCAI. And NFAI is the changes that we find in the net fixed assets plus our depreciation. The NCAI is the change in CA minus the change in accounts payable and our accruals. And you can practice that formula too. All right, so let's go on to our video that I have for you guys. I'm going to do some screen sharing and show you the video that I have for you on the statement of cash flows. I have probably 20 more of them available on my website at deborahtuohy.com, spelled out just like my name is. And you'll see the reason I have so many is because, first of all, it's been something that I am personally in charge of at the firm and have been for the last 12 years. It's also a great topic, and my students ask a lot of questions on it. So for each of those reasons, I've got a lot of videos on it. And here is one for you. It's pretty short. Adjust your volume if needed.
Financial accounting. We're going to talk about the statement of cash flows, which to me is the most practical of all statements because that's how we run our lives. How do you get cash and how do you spend cash? And we will learn there are three basic sources and uses or inflows and outflows of cash. Those come from operating activities, and those operating activities primarily have to do with the income statement. And you'll know that the result of the income statement is net income. So that's always the very first thing on a statement of cash flows. We're going to put down our net income. Then we're going to cruise through the income statement and look for any non-cash revenue and expense items. And so those include things like depreciation expense. Now, since depreciation does not take any cash or spend any cash, we want to add it back. So we're going to add back depreciation to net income. We will also add back any losses because losses did not take any cash out of our pocket when we had those, when we sold our investments or our property, plant, and equipment. Likewise, we will subtract out any gains that we had when we sold investments or property, plant, and equipment because the gain isn't what put the cash into our pocket. It's the cash proceeds from that sale that did it. So we're going to subtract that. In addition, we're going to be analyzing our current assets and our current liabilities. So current assets and liabilities, we're going to look at them for changes. And what we want to look at here is, remember, current assets and current liabilities are our daily activities that go into the daily operations, meaning the income statement. How did you do this period? So the changes in current assets like inventory, accounts receivable, there's ups and downs, means that cash is coming in or going out of our business. Likewise, our liabilities, like current liabilities, like accounts payable, their ups and downs, again, are the ebbs and flows of cash going in and out of our business on a daily basis. So looking at the changes here in current assets and current liabilities and adding or subtracting them accordingly will give us the cash from operations. So we may have a net income on the income statement, but what the real question is how much money did your business generate? So that's what cash flows from operations will tell you. The second section is the investing section, and in the investing section, we're going to be analyzing our non-cash assets. Did they go up? Did they go down? And if they went up or down, how much cash did they either bring in or did they spend? So what am I talking about when I say non-cash, non-current, that should be non-current assets. The non-current assets that I'm talking about are your long-term investments, not the investments that you make because you've got a little extra cash around and you want cash management investments, but long-term investments, or things like property, plant, and equipment. Did you buy a car this year? Did you sell a car this year? Did you buy a building this year? Did you sell a building this year? So those changes in my non-current assets will either bring in cash or reduce my cash because I made those decisions. The last section has to do with financing. And when we look at financing, we're going to be looking at our changes in our long-term liabilities, such as long-term debt. So if you borrowed long-term debt, does more cash come in? Yes. If you repay long-term debt, does cash go out? Yes. So we're going to look at those changes for the increases or decreases they incur. Also, we're going to look at our changes in our stockholders' equity accounts for any changes that they incur, and we will add or subtract them accordingly. In other words, things like, did we pay a cash dividend this year? Did we sell stock? So those types of things either bring cash into the business or go out. That will give us, when I add and subtract accordingly, our change in cash. And you know what? You'll know that if you got this answer right, even from the beginning of the problem, because the change in cash is nothing more than the difference between your beginning cash balance on that lovely balance sheet and your ending cash balance on your balance sheet, so you know where you're heading. The final thing that you have to disclose is any non-cash changes that flip things from investing to financing or financing to investing. Since no cash came in or went out, but you changed these categories, you have to disclose it. So that's an overview.
All right, and I do recommend a lot of Susan's videos whenever you run across issues that you want to hear more about. I have vetted a lot of them.
Okay, let's take a look at the statement of cash flows. The statement of cash.
There are some others out there too, but Susan's in particular, she gets right to the point. She's a great instructor, and she puts together some excellent videos on any topic in finance or accounting that you might be interested in too. All right, so let's get beyond that. Also, let's see what I want to tell you guys, a little bit about what's in our chapter on the statement of cash flows. I'll put some slides up. Again, adjust your screen if needed. And this is just some good material I have on it. It's not aligned with your chapter. It's a nice explanation of the statement of cash flows that I've saved. And so we know a little more than we knew before, right? We know why this is so important. Those of you that have had accounting classes or other financial analysis classes may have seen this before, but when you first go through it, it's something new, and the concept seems like, well, I guess one of the few questions I wondered was, why did I bother to do my financial statements in accordance with GAAP on in that format when I realize that I'm going to need these? And it's that you're going to need both. You're going to need both. So you want to put things in compliance with GAAP to align your transactions when they incurred, income when it's earned. And so even though it seems that you're making up two sets of statements almost, which you really are, a little bit of a duplication of efforts there, they provide such different purposes. Also, being able to predict cash flows, I want to just mention, is a really, really good skill to have in a firm. So if you find that this comes easy to you, or that you have a knack for it, or a crystal ball for some of it, and I don't mean just in doing the statement of cash flows, I mean in the cash budgets, which is also in our material, predicting the future, where the cash flows, statement of cash flows is a statement showing activity that already just occurred. But when you do the cash budgets and you predict how much cash flow will be needed, what the cash balances will look like in 7 days, 30 days, 60 days, having a knack for that is quite valuable to the firm. Kind of how I made my name years ago. So, all right. So we see what it is. It shows where cash came from and how it was spent. We're going to look at those decreases and increases. And we see over a period of time. So we're going to pick, let's say, last month, last year, last quarter, whatever we're asked to do. And then we see the link between the other two main financial statements, the balance sheet and the income statement. So here we see predict future cash flows, evaluate management decisions, and then predictability to pay debts and dividends. And dividends are going to be critical, especially to the larger firms, right? Investors may expect a dividend. You may give a regular dividend. It may not be the corporate setup where you just decide that you had a good quarter and you're going to declare a dividend. You may be one of those blue chip stocks that your investors receive a dividend every quarter and use it to pay their expenses, especially a lot of retirees. So this might actually be a true obligation, even if not on paper, even if not legally an obligation, if you haven't declared it yet. But you're going to really upset investors if you don't have the ability to pay your dividends. Just some definitions, the cash equivalents. We see this in economics too, if you've seen it before. And we have cash equivalents, items that are similar to cash. So we have cash and cash equivalents put together. Normally they're put together because, let's say we have a money market account or the U.S. government securities. I can convert those into cash within less than 24 hours. So basically those are cash. For the purpose of any type of discussion, we can treat them the same as cash. It's a place that we are putting our excess money without any restrictions or very little, so that we can at least earn some sort of interest on the money in the meantime. However, it is very, very easy to put it back to cash. So here is our 3 sections on the statement of cash flows that we discussed: the operating, the investing, and the financing. The operating activities, like we mentioned already too, is those day-to-day transactions. Those that create revenues, expenses, gains and losses, and that make up net income. And of course, they also affect balance sheet. Investing activities, we see some examples, are those transactions that increase and decrease long-term assets. So those will be major assets: computers, building, land, plant, equipment, and also under that, loans receivable. So if we have lent out some money, that is an investment, right? To us, it's an investment. A loan is a liability to us, but if we're the one borrowing, but if we loan someone money, that's an asset. And lastly, we have the financing activities, the increases and decreases in long-term liabilities and equity. So if we issue new shares of stock, if we pay that dividend, buying and selling treasury stock, and treasury stock, if you recall, is just shares, buying the shares of your own firm. A couple of reasons why you do that. You can feel free to expound on that topic if you like, but that's where those treasury stock transactions would go. And then borrowing money and paying it back. That's financing to us. So now we see a nice visual, the operating, investing, and financial activities and balance sheet. We see that under the current assets, we have those long-term assets. Under the current liabilities and equity, we have those liabilities that we talked about and the equity transactions. There's going to be 2 ways to put together a statement of cash flows, and I would not get too hung up with it. Some students do, sometimes I do. Basically, you're going to do the format that you've been asked to do. So I wouldn't worry which one is appropriate unless you're in upper management at this point. They say this is the format we use, this is what we have decided to use, and that's how you have to prepare it. But there are 2 methods coming up with the same results, the same amount of cash flow in each of the categories. However, different ways of presenting it and calculating it. The indirect method we see, we begin with net income, and then we adjust it to net cash provided, and it is the most popular. The direct method is going to take and recast the income statement back into the cash format and shows the receipts and payments from the operating activities. So into the indirect method. Well, what we do is we need our supplies, we need our material, and what we need is we need to gather the income statement and beginning and ending balance sheet. So the current income statement for the period we're talking about, and then the balance sheet for the beginning and ending of the period that we're preparing it for. We lay out the statement format, compute the changes in cash from the balance sheet, step 2. Then we're going to go into our income statement and pick up the following numbers: net income, depreciation, any gains or losses, and then complete the statement. A lot of times you're going to see that these are automated processes, but to know how to do one manually helps you understand where the numbers come from. Are the reports that you just generated accurate? And be able to explain them to managers, board members, leaders, auditors, and examiners. So this visual is cute. It shows you the changes in current assets and current liabilities. A little good handout to have. And here's just a little excerpt of what it would look like for the operating activities, a little excerpt in the indirect method. And I'm skipping around a bunch. I can distribute this too if you guys want to see it on your own also. But this is how we compute it. We can go across. We can do it this way, which is the more kind of the more updated way to do it, or you can just do it in an Excel spreadsheet. So those financing activities that we've talked about, we know most of those. We know those are going to be our payments on long-term notes, those treasury stocks, which are stocks that we buy back of our own, and then analyze accounts, where T accounts, if you remember those from accounting, will help. And here's where we show how to go from beginning notes payable to ending notes payable, and for the issuance of stock. Two good examples. On to financing, and I'm just going through some of it a little quickly, but those are some of the items that you will see. Free cash flow, we already went over. So we see that free cash flow is equal to the net cash by the operating activities minus cash payments planned for investments in long-term assets. And a lot of firms do use their free cash flows in managing their cash and their operations. Lastly, we have the direct method, and I probably will, I'm going to take you off screen sharing for that too. I can distribute that to you guys, but considering that most of this is, of course, not done by hand anymore, I think seeing one method is probably good enough for today. Both of them are available in your book and also on my website. So if you feel that need to look at some other methods, but probably seeing them both in the same day might just not give the desired results. However, you'll be, like I say, doing the format that is requested of you. So again, it may not even be important to learn both, depending on if you're going on to take certain various financial or accounting examinations, professional designation, certifications. You'll need to know them, but at least you've seen one in full, and if you feel free to, maybe in a day or two, go back in and, go through the steps in the other format. All right, I believe that that's all I have for you guys today. Just double checking here. Okay, yes, that's all I have for you guys, but I do want to make sure that you are familiar with both formats, also cash budgets, which is discussed in the chapter, the free cash flows formula, and you'll be good to go. If you have any questions, as always, I'm here for you guys. I'll see you in the forums. I'm there every day. So even if you don't hear me speak to somebody in the forums, I'm still reading and lurking and seeing where you guys are at. So feel free to reach out to me anytime, and I will be there later tonight and also tomorrow, and of course every day thereafter. So thanks for listening. I'll be posting the recording shortly. Have a great week. Bye-bye.